The first and arguably the most important step to investing in a 401k or in general is to determine one's asset allocation, which is basically a fancy word for the mix of investment category one has in their portfolio. It's been shown in numerous academic studies that the allocation decision drives about 90% of the results of an investment portfolio. So it's really important to think about this question and give it some serious thought because it will drive most of the results of anyone's investment portfolio. I want to share the framework that I use to think about this decision. And let's start by defining the basic building blocks of asset allocation. At a high level, you have three basic types of assets. You have stocks, you have bonds, and you have cash. I don't want to go deep into what a stock is or what a bond is, what the differences are, but I do want to emphasize that stocks are the riskiest and cash is the safest, typically. So bonds tend to move also in the opposite direction to stocks. So they are, and generally speaking, not always the case, negatively correlated to stocks. So on any given trading day, when you see stocks increasing, you are likely to see bonds decreasing and vice versa. They tend to move in opposite directions. Sometimes bonds can be thought of as a dampener to risk, to stock market risk. And I do want to emphasize that from left to right, you have higher risk to lower risk. And the first question in the asset allocation decision is how much of each of these ingredients, components, should you have in your portfolio? I mean, how do you answer that? Well, it can be answered multiple ways, but I want to show you my framework. The mix of the three components really reflects risk tolerance, which in my opinion is the most important factor in determining asset allocation. How risky do you want to be when you're investing? How much risk do you want to take in putting your money to work? And here's some examples of asset allocation mixes. If you're an aggressive investor, most of your money will be in stocks and less of it will be in the bonds and cash category. If you're a moderate investor, about evenly split stocks and bonds and cash seems appropriate. If you're a conservative investor, you would have more in bonds, less in cash, and less in stocks. And if you're a really conservative investor, super ultra conservative, maybe you have everything in cash or very little exposed to stocks and bonds. One rule of thumb that is often cited in the personal finance and investment world is that you should have 100 minus your age in stocks. So if you're a 25-year-old starting first job out of college or so forth, maybe you have 75% of your exposure in stocks. And intuitively, this should make sense because the younger you are, the more risk you're generally willing to take in that investment program. This is the rule of thumb. Again, very crude, but it could work because it's simple to understand and implement. Another way to think about this decision is to look at the glass half empty. Now, I wrote an article on this, and my basic argument is that investors should design their investment programs for the worst case scenario. Now, when I say the worst case, I don't mean the absolute worst case, right? Because that could be World War III, or the Earth gets hit by a giant asteroid, or a nuclear bomb goes off and everything goes to heck and nothing is around, right? That could arguably be the worst case. I mean the 90% confident worst case in investment returns. And one way to develop this likely worst case scenario is to look at historical returns. That is the best guide for the future, even though it's not guaranteed it's going to be like that in the future. Let's assume that one invested $100,000 each year between 1928 and 2013. And we did so in a U.S. diversified stock portfolio. And the question is, what would be the worst case under those various scenarios? Well, this table I put together, and you can replicate it using one of my web-based tools that I will discuss later, shows what happens when you invest in different mixes of bonds and stocks. So for example, you can see on the table that if an investor had put 100% in stocks, the worst 1 year return would be about worst 1 year ending value would be $56,000. Now, that assumes, of course, that there are no fees, there are no taxes, other detractors. But you can see on this table that as you increase the number of years that you're invested, the likelihood of losing one's principal, one's original $100,000 investment, goes down significantly. For example, in the worst consecutive 30-year period would have resulted in about $1 million. So your $100,000 would have ended up in $1 million in the worst of scenarios over a 30-year period. Again, doesn't assume taxes, fees, and so forth. And the name of the game here is to wait as long as possible to reduce risk. In a table like this, which you can replicate using my tool that's located at allocation.myecfo.com. Once again, allocation.myecfo.com. A table like this can be very helpful in thinking about how much risk do you want to take and how much loss are you willing to withstand. And I recommend to my clients that they look at the 1 year worst case return. If they can handle that drop, then they can increase their risk level. If they cannot handle that drop, then they should reduce their risk by either increasing bonds and cash in the mix or just maybe not investing at all. I think it's very important to understand that risk level.